Hello everyone, welcome again, and right away we're going to take a look on an investment appraisal question on ACCA June 2013 question 1. The question is as follows: HDW company is a listed company which plans to meet increased demand for its products by buying new machinery costing $5 million. The machinery would last for 4 years, at the end of which it would be replaced. Then, the scrap value of the machinery is expected to be 5% of the initial cost. Capital allowances would be available on the cost of the machinery on a 25% reducing balance basis, with a balancing allowance or charge claimed in the final year of operation. Actually, about the balancing allowance or charge, you can find it at the end of the year. You compare the carrying amount 1 year before to the amount you receive at the end of the year, which is the scrap value initial cost. Right? Okay. This investment will increase production capacity by 9,000 units per year, and all of these units are expected to be sold as they are produced. So, units produced will be equal to units sold. So, the same number of units will be used to compute sales as well as costs. Relevant financial information in current price terms is as follows. So, we are given the selling price. Here is selling price per unit, inflation, variable cost per unit cost, inflation, as well as incremental fixed cost. Note that incremental fixed costs represent relevant costs because they have arisen as a result of meeting an increased demand, so they are relevant. In addition to the initial cost of the new machinery, initial investment in working capital of $500,000 will be required, and investment in working capital will be subject to general rate of inflation, which is expected to be 4.7% per year. So we have also been given inflation on working capital. HDW company pays tax on profits at the rate of 20% per year, 1 year in arrears. What does this mean? This means that HDW company pays tax 1 year after earning the profit. So, tax for the profits of year 1 will be paid at the end of year 2, etc. The company has a nominal money in money terms after tax cost of capital of 12% per year. You know there is something called nominal rate as well as real rate. By nominal rate, we mean that inflation is already in there. And by real rate, we mean that it excludes inflation, but we are given the nominal rate. So actually there are two different approaches, and we'll just use the nominal and I will explain the real one at the end. So let's proceed with the question. Required, calculate the net present value of the planned purchase of the new machinery using nominal approach and comment on the financial acceptability. Solution. Now, we have been told that the project is for 4 years. So year 1 up to year 4, but we have added year 5 because the tax is paid 1 year in arrears. Then we assume that our currency will be in $1,000. We start computations. We compute the profit for the period for the project, which is sales less all costs, variable as well as fixed. Now, how do you obtain our sales figure? This is our sales, and to know how you obtain the sales figure, 1 year, 2 year, 3 year, 4. Units sold given the question, we are given 9,000 for all years. We are given the selling price of 650 without inflation. That means in current terms. And now we have to inflate these values. So here is our inflation factor. The inflation factor actually will inflate selling price, and then we'll multiply selling price by the units sold to obtain total sales. So the inflation factor equals to 1 plus inflation rate brackets power n, but the inflation rate on sales selling price was 4%, so 1.04 power n. So for year 1, 1.04 power 1, for year 2, 1.04 power 2, for year 3, power 3, and for year 4, 1.04 power 4. And now you can compute your sales. So our sales figure will be equal to the units sold, Roman 1, times Roman 2, which is selling price, times Roman 3, which is the inflation factor. You multiply this 9,000 times 650 times 1.04 power 1, you obtain 6,084. The same applies to year 2, year 3, and year 4. Here, so this is how these figures were arrived at. Then we go next. Variable cost. What about the variable cost? The same applies. To obtain the variable cost, we take the variable cost per unit times units sold, because units sold are equal to units produced. But we are also given inflation, so we also have to work on the inflation issue. So we go unit variable cost, we are given 250 throughout, and then we are given the inflation of 5.5% on variable cost per unit, and so inflation factor will start with 1.055 per 1.4, and then we compute our variable cost. To obtain the variable cost, we first inflate our variable cost per unit by multiplying the unit variable cost by the inflation factor, and we multiply the result, overall result, by Roman 1, which is our units. So 9,000 times 250 times 1.055 power 1, you obtain 2,374. For year 2, we take the units 9,000 multiplied by 250 times 1.055 power 2, and you obtain 2,504. The same for year 3 and year 4. We go back. Now, sales minus variable cost, you obtain the contribution. So you just minus sales minus variable cost, 623. And after that, we are ready to subtract our fixed costs. So fixed costs before inflation, we are given 250 for 4 years. We are given the inflation factor of 5% here, so we multiply by the inflation factor 1.05 power 1, 1.05 power 2, power 3, as well as power 4. And then we compute our fixed cost by multiplying the fixed cost before inflation by the inflation factor. So 250 times 1.05 power 1, you obtain this figure. 250 times 1.05 power 2, you obtain 276. The same goes for year 3 and year 4. Then this is how our figures in the solution above were arrived at, these figures here. Then after that, we can subtract fixed costs from contribution to obtain the cash profit before tax. So this is the cash profit that you obtain before tax. And up to here, we are now ready to subtract our tax expense. So tax, it was 20% on the cash profit figure, and year 1 we had 34.47. So we multiply by 20% and we obtain this figure, because the figure will be paid in year 2, and this is and here we represent cash flow. So cash will actually be paid at the end of year 2. So 689. And as for year 2, we multiply 20% by 35.47, and the result is here 709. For year 3, we take 36.49 times 20%, and the result is here. And for year 4, 37.53 times 20%, and the result is here 751. So this will be the tax charge. But in the question, we are told about the capital allowances. Look here, capital allowances would be available on the cost of the machinery on a 25% reducing balance basis, with the balancing allowance or charge claimed in the final year of operation. But we are also told that the machinery would last for 4 years, at the end of which it would be replaced. Then the scrap value of the machinery is expected to be 5% of the initial cost. So we are also given a hint on the amount the machine could be sold at by the end of 4 years. So by capital allowances we mean depreciation, and this is the tax allowable depreciation. So actually it's a tax allowance. So first of all, we have to compute depreciation and then compute our allowance on such depreciation. So we can go back, benefits, making 4. Now the capital allowances. How do you obtain the capital allowances? We know that by the reducing balance method, to obtain the depreciation, we'll take the depreciation rate. We are given 25%, and we multiply by the cost of the equipment. And actually, the machinery was initially obtained at 5 million. Remember that we had the 3 zeros upwards. So 0.25 times 5,000 will have 1,250, just like this. And then for year 2, at the end of year 2, there is a simple way now to make this very clear and just simple for you, so that you do not waste a lot of time. So at first use 0.25. From the second year, take 1 minus 0.25 and have 0.75, and always take this figure here, this capital allowance, you multiply by 0.75. And note that 0.75 plus 0.25 should give you a value of 1. So 0.75 times 1250, you obtain 937.5. Actually, you might use the convention method or the reducing balance method, but actually it will take you so much time. So at the end of year 3, what will be our depreciation? 937.5 times 0.75, and you obtain 703.1. Now, at the end of year 4, we won't do it in the same way, because we are just going to dispose our machinery. So first of all, we would have to know the carrying amount at the end of year 3, just before the end of year 4. So at the end of year 3, we'll have to compute our carrying amount of the machinery, and to obtain that, we first have to know the accumulated allowance. Now year 1 it was 1250, year 2 937, so 1250 plus 937.5, we obtain 2187.5, plus 703.1, you obtain 2890.6. So this was the value at the end of year 3. So we know that initially we incurred a cost of 5,000 to purchase the machinery, and to obtain the carrying amount, it will be very simple. We will take 5,000 less 2890.6, and we would have this value. So this will be our carrying amount. So you can just note this, what happened at the end of year 4. So at the end of year 4, this was our carrying amount, 2109.4, but the scrap value, we are told in the question that it was only 5% of the initial carrying amount. So if you take the difference, it seems that we had a machinery of this value, but we received only this. Note that 0.05 times 5,000, you obtain 250. So we had a machinery of this value, 2109.4, but we could only recoup 250. So that means that is a tax charge, right? That's balancing allowance or charge claimed in the final year of operation. What does this mean? Balancing charge or allowance. By balancing allowance, it means that we received less than what we should have received, so we're given tax benefits. And by the balancing charge, it means that we received more than what we should have received. So going back to, we can just compare and see what should actually have been done. This is what we had, but we received only 250. So by only 250, it means that we had to be given an allowance, right? Yeah, so this is how we deal with it now. It's very easy. We can now compute our costs very easily. So we go back and see the solution. Our solution here. This is the tax benefit. So first of all, we'll take 20% of the amount in year 1, and we'll have 250. With amount 20% of the amount in year 2, we'll have 188, year 3 141, and year 4 372, that will be received in year 5 actually. Now this is how we arrived at our figures. 20% of 1250, 250. 20% of 2187.5, this figure here. 20% of this 2890.6, this figure, and so on. So this is how we go about it. Now we might go back to our question and finalize. So after here, we'll have the cash flow after tax. Then there are two things we haven't included yet, working capital as well as scrap value. So starting with working capital required from the question was $500,000, and we are given the inflation rate. So to know how we arrive at these figures, we might go to the next section and see what really happened. Working capital. So we had 4 years of the project in $1,000. Working capital before inflation was $500,000. After inflation factor, which was 4.7%, this is what our working capital required would be. So here 500 times 1.047 or 2524. This would be the working capital required by the end of year 1. And here the same working capital required by the end of year 2. This by the end of year 3 would require this working capital 500 times 1.047 per 3, which is 574. And at the end of year 4 we would still be requiring the working capital. Note one thing. The question says that the machine would be replaced. So if the machine will be replaced, then we wouldn't need to take back our working capital. So if the question didn't say that we would replace the machine, we would have to take back our working capital. So the working capital required at the end of year 4 would be 0. It would be nil over here. So you have to take a lot of note on that. I hope you understand each other on this issue. Or we might go to the question so that I stress it more. Here we were told that the machine would last for 4 years, at the end of which it would be replaced. This factor, this point, there is a very big point here. The machine would be replaced, so we would not recoup our working capital. Right here, as you see, and you obtain 250. So we can have our net cash flow. This will be our net cash flow. And then we discount our net cash flow. So the discount factor given in the question was 12%. It was a 12% discount rate. So 1.12 per negative n. And we compute it. We'll end up with this figure 0.839, 0.797, 0.712, 0.636, and 0.567. Then we multiply our net cash flow by the discount factor to obtain the present value. So 34, 23 times 0.893 obtain this figure, and we do the same for all remaining cash flows. And so if we add all these figures here, we'll have our present value of future cash flows is 9,066,000 and 3,000. So this is the present value of future cash flows, and all we have left with is just to subtract the initial outlay costs, which is the machinery as well as working capital costs. Machinery amounted to $5 million, while working capital amounted to $500,000, the sum of which is $5.5 million. And if we subtract this from the present value of future cash flows, we have a net present value of $4,163,000. So this is how we arrive at working capital. Now the decision, we are told to check on the financial acceptability. So since the NPV is positive, that means the purchase of the new machinery is financially acceptable. We might go back to our question and see what we have to do next. Here, B, discuss the difference between a nominal approach and a real approach to calculating net present values. Alright, the nominal approach inflates cash flows in current terms to reflect future terms using specific inflation rates, and then discounting such cash flows using nominal discount rate obtained by incorporating the general inflation rate in the real discount rate. So that just means nominal cash flows should be discounted by the nominal discount rate. On the other hand, the real approach eliminates general inflation from the nominal cash flows first. So for example, in our question, the cash flows we obtained before, like for example the cash flows here, 24, we have first to eliminate the general inflation. After eliminating the general inflation, you then discount our cash flows using the real discount rate. So in the question we are given the nominal discount rate of 12%, but we would have to eliminate inflation within it and obtain the real discount rate. And this is how the real and nominal discount rates are related. That 1 plus nominal rate equals to 1 plus inflation rate in brackets times 1 plus real rate in brackets. And we might go to the last section. The last section of our question, we are asked about the financial objectives of the organization in relation to this project. So the first objective would be the maximization of shareholders' wealth. That's the general. Actually, this is always the primary goal of the company, that is profit oriented. Maximization of shareholders' wealth. How is this related to our project? As long as our project is concerned, we say that more demand satisfaction, because actually the project was developed to meet more demand. So more demand satisfaction will lead to a higher reserves in retained earnings, and this will be actually reflected in the share price rise or maybe payment of dividends. So actually this is maximize shareholders' wealth. But also the financial objective is always to achieve a target earnings per share. Earnings per share means earnings divided by number of shares. So meeting the increased demand will lead to more revenue and hence more profit, thereby increasing earnings per share. But this will be true provided there is a careful deliberation on the funding structure used. On the funding structure, I mean, if your funds are involved a lot of debt, that means you'll have a lot of interest, and a lot of interest will actually reduce earnings. So you have to take care of that. Thanks for watching, and you can subscribe for regular updates. Goodbye.